This video is about how to put together a trading strategy if you are a beginner trader and what makes a good trading strategy. But first, what is a trading strategy and why is it so important to have one? So a trading strategy is a set of rules that traders use to help them decide whether they want to buy or sell a financial asset and when they want to enter and exit that trade, as well as what they're prepared to risk on that trade. So why is it so important to have a good trading strategy? Well, most traders come into trading with the hope that they will make a profit. However, it's worth realizing that trading is risky and it's always possible to make a loss. For this reason, it's really important to have a clear trading strategy for your risk management, but also to give your trading some structure, to help reduce emotional decisions, to help you set goals, to improve consistency, and also to monitor your performance. So what makes a good trading strategy? Well, we're going to head over to ThinkMarkets now, and I'm going to show you the components that I think make up a good trading strategy. So a good trading strategy should have a handful of confluences which all point you in the same direction and help you enter and exit a trade. One of the first elements of a good trading strategy is being really clear on what market you're trading and in which session you're trading. In the previous video, we go into choosing a market and a session. So if you're not sure which market or session you want to trade, make sure you head over to ThinkMarkets YouTube channel and watch the previous video after you've finished this one. When you know what market and what session you're going to be trading in, the first thing I would say is you want to think about time frame. So some traders, when they first start trading, will have an idea that there might be just one time frame that they want to use, and that is going to be the best time frame to trade on. But the truth is, actually looking at multiple time frames can give you an edge in trading. So my first tip for putting together a good trading strategy is to make the most of multiple time frames. And what you want in an ideal world is for all of the time frames to be showing you the same direction. If you're starting to get mixed signals on different time frames, it could be a sign that you're not ready to enter into a trade. A famous trader once compared time frames to the ocean. He said that small time frames are like ripples, medium time frames are like waves, and the higher time frames are like tides. You don't want to be obsessed with the ripples if the tide is going in the opposite direction. So always look at multiple time frames, give greatest weighting to the highest time frame, but in an ideal world, you want them all to add up to the same direction. Another component you can look at when you're putting together a trading strategy is using an indicator to help give you a very binary set of rules as to whether you're looking for a buy or a sell. If you're on ThinkMarkets, you can find your indicators here. If you click onto this one, you can search for different indicators. There are many very good indicators, and which one you choose is going to be a very personal choice. But I'm just going to give you an example of a way that you can use an indicator as part of a trading strategy. One that's really popular, especially with new traders, is, for example, a moving average cross. Can you see that these two lines have come on the chart? Moving averages are lines which are plotted onto the graph which show you the average closing price over a certain amount of candles. You can see that we have two lines here. One is a 9 moving average. This shows us the average closing price of the last 9 candles. This one that's a little bit further away is a 26 moving average. It shows us the average closing price of the last 26 candles. Some traders like to use this sort of indicator. When the lines cross over each other, it gives them a signal to buy or sell. So for example, when the candles are above the moving averages, that could mean that you're looking for a buy position. When the candles are below the moving averages, that could be when you're looking for a sell position. You can see, obviously, sometimes it works really well and sometimes it doesn't work very well at all. That's why you always want a handful of confluences and not just to rely on one indicator. This is just an example of an indicator which beginners find easy to understand, which is why I used it as an example. Personally, I like to use a momentum tool to help me gauge the momentum of the market. So the momentum tool that I like to use is called Heikin-Ashi. They look similar to normal candlesticks, but they use a slightly different formula which shows the average of the candlesticks and therefore gives a smoothed out appearance and helps us to gauge momentum. In the next video, I'm going to be going into my exact trading strategy. So I'm going to show you exactly how I use this tool as part of my strategy. So if you don't want to miss that video, make sure you hit subscribe to ThinkMarkets now and also click the bell button so that you're notified about all future videos. Also, a personal choice for my trading is to use the Economical calendar. Not all traders like to include economic data in their trading strategy, but I'm a firm believer that you need both technical analysis and fundamental analysis. So I would say if you are a beginner trader, the best way to use the Economical calendar is to look for high impact news and make sure that you're not in any open trades when high impact news is coming out. High impact news can cause huge volatility and big unexpected spikes in the market. So if you don't understand how the news works and how it can affect the markets, the best thing you can do is to avoid being in a trade altogether. A little bit further down the line, once you've had a chance to understand economic data and how fundamental analysis affects the market, you may be able to use this more effectively to understand whether you'd like to take a buy or a sell position. A good trading strategy should also have a confirmation. So whilst you're looking at different time frames and different indicators and different tools to help you decide on what direction you're looking at, you'll also want to have a confirmation, which is an exact precision of entry and the moment that you decide that yes, you are going to get into a trade in that direction. So I would usually say the confirmation should be a candle formation on a small time frame. This helps you to be really precise and helps you to know exactly when you're going to get into that trade. Again, in the next video, I'm going to go into my exact trading strategy. So I will be telling you an example of an exact candle formation on a small time frame that works as a confirmation. You're also going to want to know what your stop loss and your take profit is. So this is the maximum loss that you're prepared to take and the maximum profit that you're going to take as well. You want to have a risk to reward ratio of at least 1 to 2. Here is a really easy way to think about risk to reward ratio. If a man in the street said to you that if you give him $1, he's got one hand which has got nothing in it and one hand which has got $2 in it. You've got a 50% chance of getting nothing back for your dollar or getting $2 back. That's a risk to reward ratio of 1 to 2. That offer doesn't sound that appealing, to be completely honest. Just $1 for 2 doesn't sound that exciting. But imagine he said, if you give me $1, you've got a 50% chance of getting nothing, or you've got a 50% chance of getting $10 back. Suddenly that seems a little bit more exciting. You'd be more willing to risk $1 and get nothing with the chance that you could get 10 back. So that would be a risk to reward ratio of 1 to 10. That's the sort of thing you want to be thinking about when you're looking at a trading strategy. The higher your risk to reward ratio, the more attractive the trade is as a prospect. I would always say you want at least a 1 to 2 risk to reward ratio, but preferably higher. The other thing is that you want to be realistic with your risk to reward ratio, because it's all very well saying you want a risk to reward of 1 to 100, but if the market isn't realistically going to ever reach the point of 100 for your reward, then there's no point in holding that trade. You're better off taking the 1 to 2. So now you know what the components of a trading strategy are. You may feel ready to go off and try and put together a trading strategy yourself, or if you want some further guidance, in the next video, I'm going to be sharing one of my trading strategies. So if you want to make sure that you don't miss that video and you can see a step-by-step guide of the exact strategy that I trade, you can follow ThinkMarkets now and hit the bell button so you don't miss that video. And if you found this video helpful, make sure you give it a little thumbs up.